Hi, everyone. Apologies for not being there in class today, but excited to walk you through the current state of venture capital funding, especially as I've experienced, given that I am a pre seed founder that recently raised a round of funding. So here's what you see in this graph. There is an AI founder frenzy. VCs are investing in AI startups more than ever before. In 2024, actually, nearly 33% or one third of all global venture capital funding was directed to AI companies, which sounds like good news for all of us, but it doesn't really show the whole picture, as billions and billions of dollars were invested in large AI companies like OpenAI. And you'll see down there Databricks, Anthropic. These are large companies. So when we look at the total overall funding, we're actually seeing a lot of those really large rounds. And on the early stage side, it's not always the same thing. Because remember what we talked about back in session 3? AI has made it a lot easier to build software, which means venture capital is in kind of a weird state right now. So the reason for that is, of course, with AI, you can produce better code with AI assistance, you have faster prototyping, ability to test with a real working MVP. And there's this perception that you could easily reach 100 million ARR, annual recurring revenue, with a small team and bootstrapping. We already went over the cons before, but there's that low barrier to entry, which means that it's easier than ever to be copied, kind of ripped off. And there's limited ability to differentiate on technology. And there's a temptation to differentiate on price, which could mean could mean less overall returns for those VCs. So that brings us to, what does that mean for VC funding? If it's easier than ever to build technology, and if anyone can do it, and that there's less ability to differentiate between different products, and particularly in B2B SaaS, we're really getting kind of a glut of products all doing the same thing. What does that mean for venture capital funding? So traditionally, I would say that we were in the kind of that pre-product stage. So when you went out to raise your first round of funding, traditionally as a startup, like coming out of Duke, for instance, you would typically be at that idea or initial MVP stage. You might have built something out that was easy. I know Jamie talked a little bit about paper prototyping. Might have built out something easy, had some survey results, and had some conviction that you wanted to build this thing. So you were raising money from venture capitalists to build that product. Typically, you would raise at either the inception of the company or maybe a couple months in, once you've gotten that valuation validation from those customers. These were typically smaller rounds and evaluations. A $250,000 round was not uncommon during this era. There was lots of angels participating, and really a lot of smaller venture capital firms. Typically would take between 1 to 3 months to raise, and VCs are primarily evaluating team risk and also tech feasibility. How potentially possible is building this technology? Theranos is a great example of a product that actually couldn't be built. So VCs back then would really look at see, can this be built in a reasonable time frame by this team? Now we're in kind of this new era. I call it the growth pre-seed era. In this era, traction, either in the form of revenue or letters of intent, or at least pilot customers, is usually required. I say usually because, you could have a dad that is the head of OpenAI or Tesla. But otherwise, unless you've done something truly extraordinary, you're going to need to reach that traction milestone. And you're going to be raising money to fuel growth, for instance, marketing, advertising, hiring, versus building out that initial technology product. This means, of course, that people are raising later than they ever have before. They're also raising larger rounds and evaluations. For instance, my pre-seed was about 100,000. That is actually pretty low for a pre-seed round today. That's why there's less deals being done. Many VC firms, because of this uncertainty with anyone being able to build technology and a lot of copycats in the market, they have actually moved up market. So they have started investing at the seed and Series A level and not necessarily funding that initial round of funding, which we would traditionally think of as pre-seed. This makes true pre-seed investors very difficult to find, and there are less deals overall. Typically, it takes 6 to 12 months on average to raise, and VCs are primarily evaluating the team. Have you done something extraordinary? Can you succeed in this market? And your go-to-market risk. That means having a really solid plan for distribution of your product has never been more important. And we're seeing more and more founders bootstrapping to seed. So really spending the first year or year and a half, not taking venture capital money, just trying to survive off revenue. And then once they have that really strong revenue story, then they go and take in venture capital. It does mean that they'll have a much higher valuation. They'll give away less of the company, but it does make those initial months very difficult, especially if you don't have savings. So the question is, can you still raise pre-product? Kind of. For grants, yes. There are various grants designed for pre-product companies or companies that haven't generated substantial revenue. NCIDEA is one of them. They had a $10,000 grant that you can apply to if you are based in North Carolina, which you guys all are. For accelerators, the answer really is sometimes. YC and Antler are two of the most common accelerators to accept teams pre-product, but again, they are looking really intently at that team. Have you done something extraordinary? Are you the person to build this? Like we talked about in session 3. Techstars and industry-specific accelerators can also sometimes accept teams pre-product, but it's less common. They typically at least have an MVP. In terms of institutional VC funding, family offices, larger angels that write more than a couple checks a year, they almost always are requiring kind of a known entity at this point. In other words, if you're raising pre-product, you really need to have an exceptional founding team. So someone that was early at OpenAI, for instance, a highly compelling vision, a huge TAM or total addressable market, and really strong relationships. Here's one example of someone that recently raised a $1.6 million pre-seed on a $7 million post-money valuation. So they took over 130 investor intros. They had 35 initial meetings. They spent 6 months raising. They had 4 VCs that they thought that would come in, but they didn't. That's one piece of advice I'll give you guys. You've never done raising until you get that money in your bank account. And then they had one bad actor that was giving them predatory terms. So you'll see kind of the amount of funding they got ranges. They see that Blue Wire Capital and Blockwell were really a large, significant portion of their round. And they had some smaller checks as well. And then some angel checks as well. So they took in some angels and then sourced venture capital funding, which is also something that I would recommend. On the warrant side, what we did is we raised $720,000 pre-seed on a $5 million post-money valuation. So how we did that is in April, we started building relationships with VCs and applied to Techstars. In July 2025, we were accepted to Techstars with a basic MVP. October 2025, we launched our product and started raising VC. We took 96 venture capital meetings, a lot of them actually over the course of Money 2020, which is an industry conference, always a great place to kind of stack your investor meetings. And then February 2025, we closed round. We got a little bit delayed with the holidays, but the 2 investors that came in January and February, we were already talking to in December. So the question is really, should you raise venture capital given the changes in the market? So with AI, obviously there's this perception that small teams are hitting millions in revenue in months versus years, which makes bootstrapping a compelling value proposition. As I like to say, if you are bootstrapping, the chance of you, having a life-changing exit are really high versus with venture capital, if you give away too much of your company, you might not have that life-changing exit. You might need to work, you might not get that house in the Hamptons. So it's always something to consider. So I would say you should raise VC if you're building a billion-dollar business or a horizontal software. Like we talked about in session 3, horizontal software is something like Canva, Snapchat, most consumer software, something that can be used by a broad set of people and industries. In that case, you're going to need venture capital to fuel that growth on the marketing side. It's expensive to run those Google, Meta, Instagram ads, and you're going to need that amount of capital. Versus bootstrapping, it's really ideal for kind of those vertical businesses where you know exactly who your persona is. You can find them online, on social, you can talk directly to them, and you can start generating deals through sales. I think you should also raise VC if you're in a costly or competitive space. So for instance, developer tooling, extremely competitive. I would say sales tooling as well. Very competitive to kind of get an edge in that market. So I do think having venture capital funding would help you there. It's also very respected by that persona. It's another thing to consider. Or if it's in a costly space like biotech, you can't create a biotech pharmaceutical drug for less than millions and millions of dollars, in which case venture capital and probably private equity is a good fit for you. Should you raise VC if you are open to acquisition or acqui-hire? That is the most common exit for venture capital-backed companies. So if that's good with you, that's great. You might have to work for a year or two at the company that acquired your company. It can be a little tricky and a little difficult, but it is the most common exit path. It can really up-level your career if you might be interested in working in corporate America in the future, but it's not for everyone, so something to consider. And then my last point is do not raise for the prestige. I am a venture capital-backed founder. It literally doesn't matter if you're venture capital backed or if you're bootstrapping. You're all just trying to solve a problem for your customers. Do not raise for the prestige. There is a lot of cons to raising venture capital. I do have to send out investor updates, take meetings. It's very time consuming. So do not raise for the prestige. If you want to build a worthwhile business, you can do it without venture capital. Just know what you're getting into. And then advice that I have for the current fundraising environment. First is timing is everything. It will take 3 times longer than you think. We originally thought that we'd be done fundraising in October and then in November. We didn't actually close our round until February. You're also going to want to read the Venture Deals book. We didn't get to go over everything in this class today, so definitely pick up that book. It really tells you a lot about how to structure deals, what to look out for, and is particularly helpful for seed and Series A financing, but I found it helpful for pre-seed as well. The third is you're going to ask for a commitment in the second meeting. Fundraising is very similar to sales, both of which you'll have to do as a founder. Make sure in that second meeting, if an investor has taken a second meeting with you, they're very interested, make sure you ask for that commitment. Say, what would make you commit today? Or are there any hesitations to committing to my round today? That way you at least know exactly where their mind is, so you're not waiting on an investor that is never going to invest. 4, you're going to want to check Crunchbase for recent investments so you know if they are actively investing in pre-seed. All of their websites will say that they invest at first check. I've never found that to be the case. 5, I would wait to do accelerators until you're post-product. I did Techstars when we had an MVP, but I really wish that we weren't wasting valuable mentor hours on tech development, and instead we were learning more about our go-to-market distribution. So that's something I would recommend, and I've talked to a couple other of my founder friends, and they would recommend the same thing. 6 is bad actors. Try not to invest in VCs that invested in similar or competitive companies. It's kind of a waste of time. They probably will not invest, and they'll use your time as, research for them. So don't do that. 7, you're going to want to invest in a CRM both for your sales side, but also for tracking your venture capital conversations. I highly recommend Attico. They do track every single email. That way it's easy to see, okay, I last emailed this person on this date. Made it a lot easier to send follow ups. But yeah, that is it for me. But really appreciate you guys taking the time and best of luck in your raising.